Good afternoon, everybody. Thank you for joining us on the slightly delayed Cornwall Festival of Business Bishop Fleming Preparing for Brexit seminar. From the advert that went out, the invitation that went out, you'll know that Kim Conchi was due to chair it. Unfortunately, Kim has been otherwise indisposed, so I will be chairing today's session. My name is Chris Walkland. I am tax partner at Bishop Fleming. I'm also a board director and vice president for Herefordshire and Worcestershire Chamber of Commerce. We're hoping for a very productive and interactive event today. So as ever, ask questions, provide feedback, help me chair this session and get the most out of our speakers. Who are those speakers today? Well, I'm very pleased to say that we are joined today on this 1 hour quick take of Brexit with Wendy Andrews, VAT Director at Bishop Fleming. Wendy's has extensive experience in a number of different areas of VAT and focuses on making complex VAT issues understandable, which we can translate into Wendy has all the answers for Brexit, and that's why we made her head of Brexit. We're also hoping today to be joined by Catherine Mead. Catherine is the owner of Liner Dairies, who make Cornish Yarg cheese with business customers, including national retailers, airlines, and Australian and US retailers. A very impressive profile of customers there. The company was awarded Regional Manufacturing Company of the Year in 2015. So it will be great to hear from Catherine. As ever with these things, we're having a few technical issues, so we may just change the running order in a minute. But we've also got Rob, and I'm pleased to say Rob's tech is working. So Rob is with us and online. Rob Misselbrook, Chief Executive of Myler Ventures. Rob owns Myler Ventures, which is a venture capital company based in the Southwest. Working closely with angels, funds and private offices, Rob advises companies in business development and raising capital. Very important if businesses are looking to trade their way through the pandemic that we find ourselves in, and of course take advantage as opposed to worry about Brexit. Capital will be king over the next 12 to 24 months. We have suffered the pandemic since March. We left the European Union on the 31st of January. Who knew back on the 31st of January that Brexit preparation wasn't the only thing we would be wrestling with? We're hurtling towards an exit on the 31st of December without a deal at the moment. Let's hope that isn't the case. But at this point, I'm going to hand over to Wendy Andrews, who's going to do a bit of introduction, give it a little bit of a potted history and a bit of an overview on Brexit. We'll then have a few words from Rob and Catherine, and then we'll launch into the Q&A. Wendy, over to you.
Thanks very much, Chris. Good afternoon, everyone. Yes, so 4.5 years after the original referendum, we're still trading within the European Union at the moment, even though we left on the 31st of January, but heading for the full exit on the 31st of December with or without a free trade agreement, and obviously very much still waiting to see what happens on that front. As any of you who have been involved will know, over the last couple of years there have been a couple of deadlines, a couple of times when everyone's been prepared, and then nothing very much has changed. Brexit hasn't happened. I think this time round the atmosphere is very different. Everyone, I think, is pretty sure that it is going to end on the 31st of December, but obviously still that's remaining uncertainty about whether or not there's a free trade agreement. In terms, I've tried in talking to clients all the time to keep out of the uncertainty and certainly keep well out of the politics, and to focus instead on the kind of practical things that businesses need to be thinking about in the run-up to leaving the EU, leaving the customs union and the single market. And certainly in terms of indirect tax, the key area for businesses is those businesses who deal in goods with the EU. So businesses that send their goods to customers in the EU, and businesses which are bringing goods in from the EU, because that's where the real first practical issue is going to arise on the morning of the 1st of January, when there will be a customs border between the UK and the EU for the first time in getting on for 30 years. So in terms of preparation, that's a key area to be thinking about. If you're a business that transacts in goods with the EU, there are a number of things to be thinking about. In my experience, people this time round are thinking about it in a lot more detail and are putting in place some of the preparations they need. Just to quickly run through them, there's some information that you'll need to make sure you've got. You'll need a special version of your VAT number. You'll need to know the commodity code and the origin of the goods you're transacting in. And most of this preparation is needed whether there's a free trade agreement or not, because the customs border will definitely be there, even if there is a free trade agreement. The big difference with a free trade agreement is that will involve customs duties at either end of the transaction. And that's another important issue to be thinking about commercially. Who's going to be responsible for the customs duties? People haven't worried too much about those Incoterms, as they're called, or delivery terms for goods inside the EU. But once there's a customs border, that becomes very important, and that's proving to be quite a sticky issue for some people as they look at their transactions in a bit more detail. Some other complex areas, particularly for people who are selling B2C to consumers within the EU, and also people with more complicated supply chains who are perhaps moving goods between two EU member states. So just highlighting really some of the complex issues people are needing to be thinking about. I think that is probably due for an introduction. Hand back to Chris.
Thank you, Wendy. I know we are still trying to line Catherine up, so I'm going to pass over to Rob now. Rob, venture capital background. As I mentioned in my intro, capital is very important for business. I'd like to think that there might be a lot of capital sloshing around at the moment with interest rates at all-time lows, the threat of negative interest rates. I'm hoping that there may be a chance of some risk capital going into the markets. Of course, we've got an interesting dimension with the US election in the next 24 hours. I know that Trump is ambivalent to a no-deal exit, but I know Biden is very anti-Brexit and very anti-us doing anything illegal in the context of us leaving the European Union. And I dare say you'll have some views on that too. So Rob, for our attendees, it'd be used to have a bit of background on you and your take on the world as you're seeing it at the moment.
Thanks, Chris. So yeah, interesting times at the moment, sort of with Brexit and COVID. If Brexit's a wave and COVID's the storm, it's sort of trying to work out which one of those waves is Brexit. It's sort of these are very unique times indeed. I think just cover off the Biden issue first. Who knows what he's going to be like? I mean, everything is speculation at the moment. The one thing that generally unites the US is the Irish vote. So what people say in elections and what they do can be very different things. The special relationship, as I've said for years, really sits in the business and economy class of BA London to New York. That's where business is done. How that transacts itself going forward, we're all speculating and we don't know. The fundamentals are still strong between the two countries, and they always will be, I'm sure, divided by a common language, as Churchill always said. So I'm fairly positive on that side. Anything but Trump, basically, I think at this stage. And my sister lives in the US, and a lot of business contacts there as well. And just about everybody is saying the same thing. In terms of capital at the moment, we are definitely risk off, as people can no doubt guess. And by that, I mean, risk equity, young startup companies, places where you're going to risk your capital like that is a hard market at the moment, very hard. And a number of reasons for that. One is just we're all making it up as we go along, albeit with eyes open, but it's very, very hard to sort of plot a route out of this. I was just saying to the team here that, we've got BBV written on my wall here. So positive Biden, positive Brexit, and then a vaccine, and that's our route out. If we get those three, then I think there is light at the end of the tunnel. In terms of capital, the banks, the C bills and the B bills, and you will just never see capital as cheap as this again, ever. I don't think, or I hope not, for all the right reasons. So I would definitely take advantage of all of those measures. Personal guarantee rates are very low, interest rates are very low. There are lots of sort of third parties that the British Business Bank have brought in to do the C bills and the B bills. So that would definitely be the first place to go. I would caution against over leveraging, as we always do. That's maybe more of an issue for younger companies than more mature ones. And I think the other side of it is, certainly for a lot of the companies we're involved in at the moment, is just survive right now. I mean, you know, Wendy makes some brilliant points. There's various websites and government helps to go in and get up to speed on what you need to do if you're trading with the EU on a direct basis. Not a huge amount of companies are, but there clearly are some. But the methods are there. So that's really, you know, my view at the moment. Sort of cautiously optimistic with that BBV. The capital's there, but it generally tends to be in debt. And with a bit of luck, if BBV pans out, you know, in 6 months' time, the risk will be back on.
Thanks, Rob. Some really interesting points there, which no doubt we will return to in due course. I'm pleased to say that Catherine Mead, owner of Lionadare, has finally managed to resolve the technical issues. She is with us. Catherine, can you hear us?
I can hear you, and can you hear me?
Fantastic. Okay, unfortunately, you missed the glowing intro that I gave you earlier. We're recording this, so you'll be able to check how glowing it was after the event. I just wondered whether you could just do a bit of an intro, a bit of background on yourself, what you're seeing at the moment, and especially in the context of the Brexit theme we've got for today's event.
So I'm Catherine Mead, and apologies, probably my lack of technical competency, despite the millions of Zoom and team meetings that we've done in the last 8 months. I am, as you said, the owner of Lionadare. We make Cornish yard cheese. We also make Cornish kern, and we are kind of one of the biggest of the small cheesemakers, national small cheesemakers. We distribute right across the UK through the national supermarkets and retailers, independents, and food service events, etc. And our primary export markets are Australia and the US. However, we do import some to the EU and a fair bit, or an increasing amount, to the Middle East. So we are looking at, we're trying to, I think, as Rob alluded to, we're on these parallel tracks at the moment. We're just trying to deal with such volatility in the market at the moment, while trying to consider just 7 weeks ahead a significant change. But at the moment there are so many permutations on that change, it's very, very difficult to plug them into our thinking. However, what we know in food is that the UK imports 40% of its food, from the 40% of the food it eats comes from the EU, and therefore by definition, whether we have a free trade deal or if we have no deal, the supply chains and the flow of food will be significantly affected. That is absolutely indisputable. And I guess we could say the best scenario would be one where a trade deal is established and trade continues as far as is possible in its quote-unquote normal state, but there will be something between 8 and 10% price increases just because of the cost of compliance. So the cost of logistics, of labelling and of cross-border compliance is going to cost the British food producers something in the order of 10%. Now that obviously is the case before tariffs apply, and in my particular instance, tariffs are set at about 20%. So quite clearly, if we were to look at a 30% price rise, we would not have a market in Europe if that was our intention. So what we're trying to work out is what will be the various different scenarios from absolutely no cross-border tariffs all the way through to WTO, not in terms of so much of how that affects us as a business, although it does have some direct impact, but it's more of how it affects the market. and what our market opportunities are going forward, or market concerns are, the threats and the opportunities, standard stuff. And there's so much complexity built into that, because we have to consider the sterling and the exchange rate, which is incredibly important, believe it or not, in cheese buying, because there's a lot of forward purchasing. So a weaker exchange rate as a result of no deal could actually mean, bizarrely, we actually sell more cheese in this country. But conversely, a good deal would have the pound getting very strong, and we would see a lot of cheaper imports. So in either event, this is going to affect our market. So it's an interesting situation whereby we're having to do a certain amount of work around compliance, and of course we have the standard things of our ID marks and our labelling. We've had to work our way systematically through all of that. And never mind the fact that we now have to have a vet available to come and check our cheese and to give us a health certificate before it leaves the building, which is quite an incongruous kind of scenario, really. But we have to think about what the market is going to do and how the market's going to perform in this event. And one of the things that was becoming increasingly apparent is a lot, and I couldn't possibly tell you if it's most or not most, but a lot of food producers are saying, we're not planning to export anything for a couple of months, because we need to see how this is all panning out. And the last thing we need to do is to be part of a lorry chain down in Dover. So there's going to be this really interesting, on top of the impact of COVID, we're going to have this really interesting hiatus in January and February, where there is, without shadow of doubt, massive disruption to food supply chains. And it is going to happen, but it's just to what degree. So that's what we're looking at present.
Thanks, Catherine. That's really interesting. I suppose I would applaud you for the practical insight that you've given there. We know from a number of the chambers of commerce across the country have done a number of surveys, typically the Quarterly Economic Survey, and they keep reporting that not enough SMEs are engaging with Brexit. They're citing uncertainty. That is starting to change. What I'm hearing from you, Catherine, is that despite that uncertainty, it is still possible to brainstorm what the different possible scenarios might be, do a sensitivity analysis of how that might impact your business, and do what you can do to plan for that. So whilst we may be uncertain of what the outcomes are, we can nevertheless try to assess the impact on our business. And I think that is something that I would implore all businesses to be thinking about, even though there is so much that we don't currently know at the moment. It's disheartening to hear those anecdotes around businesses being dissuaded from exporting until the dust settles. We know, again, from chamber surveys that businesses that export grow quicker, develop their IP, their people, their profits much quicker than those that don't. And maybe naively, perhaps, I see export strategies as the way that businesses can trade out of the pandemic and trade out of Brexit. But your practical insight there clearly is a wake-up call that we can do the scenario planning, but not necessarily that may not be enough. Can I just take that topic and maybe move to Wendy for her take on that, in terms of Wendy, what are you seeing in terms of businesses, the steps that they're taking now and the steps that they practically can be taking now?
Yeah, thanks, Chris. Yeah, I'm starting to see businesses, and the issue is that all businesses, more or less all businesses, face different issues that are unique to their particular business sector, to their particular way they've got their supply chain organised, whether they're kind of buying in from Europe or selling to Europe. So it's quite a complicated picture, and that's why it's quite difficult to sort of to give out any kind of guidance. I find I always need to have the conversation with people about what their specific issues are, but I think this time round people are going there, people are thinking through what they need to do. moving increasingly, especially in the food sector, to perhaps setting up a new EU entity that can deal perhaps more easily with some of the formalities, with some of the inspections and some of the controls and reporting. So that's beginning to happen now when it didn't happen before. But I think the uncertainty around a free trade agreement, especially in the food sector, is huge, because that's the sector that's most badly hit by tariffs in either direction. So that is a kind of important factor that drives whether it's going to be economic to do those transactions anymore or not. So I guess that's the main picture. People very carefully thinking, not helped by the uncertainty about the free trade agreement, and also quite a lot of uncertainty from the HMRC perspective, and what things actually need to happen, what they need to do. I was looking at some of the guidance yesterday for a client, and there's still a little paragraph that says a system to deal with this will be developed sort of nearer the time. So that's causing lots of practical issues for people who are doing their best to kind of deal with what they're up against.
Okay, and I think you and I know, Wendy, from recent experiences of working with new clients, that some of them are worried about Brexit, may not be affected by Brexit, but do have international operations and actually have VAT exposures in European countries where they had an obligation to register for VAT but hadn't done so. So I think from our experience is another message here. It's not just about the things that you can be doing that are Brexit inspired, but maybe use this as an opportunity to take some time out and just check that you're compliant in the European Union for the operations that you might already have. Just hanging on to the point about the things that can be done now. Rob, what are you seeing businesses doing to try and address the uncertainties of Brexit in terms of the businesses that you are looking to are backing? And does a business that is looking, notwithstanding, given what I was saying earlier about that businesses that trade internationally tend to grow faster and be more profitable, do businesses that have an export strategy, are they more attractive to you as an investor? Are they more likely to get investment at this time?
Just to answer your second question first, companies that can export, I think you're right. It's, it depends which market, as always. The US market can be unbelievably expensive and hard to get into. The other English-speaking markets are far away, like New Zealand and Australia. But generally, exports are a great way to grow your business, but you just really have to. It's not done by mistake. I think one of the constant themes through government is, always forget what they're called, and I shouldn't really. It's a DIT now, Department of Industry and Trade. They have teams on the ground that are really very good. And with all the changes of government's colours and the rest of it, those teams have always stayed there, and they are good. So, value propositions, as we say, in terms of investments, if it's good for the UK, we're generally a pretty competitive environment. So it's generally good for exports, but it just depends which market. Which sector as well, I think, is huge. I think we have some fabulous food brands here in Cornwall, and, you're all going through your own versions of hell trying to work that out. We've seen quite a interesting. I have complete sort of faith in the entrepreneurial spirit of lots of SMEs, and we've been halfway through conversations with European suppliers where suddenly the lights come on with them, and sort of they've turned around to us and gone, if we just fix it all for you and stick 2% on the price, would that work? So the invisible hand is beginning to move there. Food is a massive issue for the French, as we know, and the seafood don't even go there. No, I'm not sure where that's going. But so trade is always good. I think Wendy makes a really good point, and just it is confusing out there. One of our businesses, we bring in a product from Holland where we own a factory there, and I think January this time last year, we bumped up inventory levels going through into and we kind of kept inventory levels up there and just traded through that. So I see quite a few companies doing that. We bring that product in through Dublin. We've got the Irish border there, so which will serve there as a soldier. I can assure you it is a porous border, and And so, we're fairly relaxed about that, but who knows what. In terms of, investment in capital, I think at this stage it's a difficult time, right? I mean, I sit there and look at the listed markets and just wonder why they're so high. And a lot of it is just quantitative easing has got to go somewhere, and it goes into a liquid market. I mean, to have a company trading at $2 trillion of it's just, my Lehman days just tells me it's madness, but it's there, right? So I think, if you are looking at raising capital now, I would honestly wait. There's so many uncertainties out there. Biden and Brexit and vaccine to be through them. It's probably not a great time to be raising risk cash. You can certainly get your EIS underway, your prior assurance. The crowd platforms are still doing quite well, actually, but they generally tend to have a UK retail focus. But and I would just focus much more on the sort of the very, very cheap leverage out there at the moment, most of which comes without a personal guarantee, which you don't often see that from the high street banks.
Okay, thanks, Rob. We're starting to get some questions coming now, which is absolutely fantastic. So please, if you haven't already, open up the Q&A panel on this Microsoft Teams call, and we will be taking the questions as they come in. So we've had a few come in already. Please feel free to ask questions. The more questions we've got, the more interactive we can make this, the more relevant it will become, because we will be able to address the points that the audience are making. So let's pick up the first question. And Rob, because it's a funding related one, I'm going to bounce this back to you, and then we can extend that. We'll then go to Catherine and Wendy for their views. So the question, what is the view of the panel on the government making up the £600 million of EU funding that Cornwall will lose due to Brexit? Boris promised to make good, but with COVID costs, this is increasingly uncertain. So is there a money tree, Rob?
Oh, where do I start with this one? I mean, who knows what the government's going to do on that. I've always been very skeptical of the EU funding down here, and it's bang for buck. I think I've got on public record saying this. I reckon about 50% of it is consumed in administrating it. I mean, I've just finished an ERDF application for a client, and oh my God, I can see why no one's doing these anymore. They're horrific. So I would caution against the EU money tree. I know it's done good things, and there has been some infrastructure stuff, which is great. And I do think there's an argument there. Without the EU, would we have got that in a Cornwall? Where I'm seeing is this National Prosperity Fund is where everything is going. We are one of the few regions in the UK. You have the Midlands Engine, the Northern Powerhouse, and the Cornwall Investment Fund. So there is capital there. I think it really depends on what you expect that taxpayer money to do down here. Grants can be, as we mentioned, can be harming some companies. Sometimes they just go down the grant tree. I think anything is better than the ERDF EU administration we had before. I really do believe that. I think in all my analysis, I think one SME got directly funded through there. Really what it funds is programs that are incredibly inefficient. So, there's 6 Tory MPs down here still. I know the Northern Wall is where it's at. What I would say is the Prosperity Fund, every time there's a budget, this seems to get bigger, and I see no reason why Cornwall shouldn't participate in that. The challenge we're going to have is they're going to say, what did you do with the 2 billion from the EU? That's the challenge, because the return there hasn't been all that great. I know there's been some good infrastructure stuff for sure. So we just need to raise our game. And, I am always a fan of private capital as opposed to public capital. Always. It's much more efficient, it performs better, and there are some platforms beginning to emerge now, like regionally and places like that, where they are touching the regions. They are specifically set up outside London. So if there's no more sort of gravy train from central government, one, I would argue whether it was gravy or tar, and 2, private capital will come back. It will, for sure. It always does.
That's really interesting, Rob. Catherine, it's interesting some of the points that Rob makes there, and I have to say I sympathise. In addition to being a board director for Herefordshire Worcestershire Chamber of Commerce, I'm also on the board of Worcestershire LEP, and I witnessed firsthand how this EU money can flow through to the regions, and suddenly go from a big number to what it becomes inefficient capital. What's your view on, as an entrepreneur yourself, knowing the challenges of funding business and what makes a good business? What's your view on that EU funding and what we might do without it?
Well, I do have certain sympathies with what Rob has said. I think some programmes have been more successful than others in terms of getting money to the right place. So my greater experiences of agri-food and of that tranche of Objective 1 funding, where there was this dual opportunity to get finance and capital into aspirational, ambitious and inspiring businesses who could then grow. And the consequences of that growth are now fairly apparent, and there's some really great examples of that. And by the same token, there was an element of what one might call risk capital, which enabled small entrepreneurs, smaller businesses who were terribly undercapitalized and couldn't go to the banks and couldn't get the private equity or investment, and it just gave those businesses an opportunity. Now, some of those will be successful and others won't, and one could argue for probably quite some time as to whether or not that is a good use of taxpayers' money, whether it's EU or UK government based. But what I think is going to be really important is we needed, and I think way back when we were talking about the need for support in export programs, and interesting, I was looking at something today from the LEP and the Marshes, which must be pretty close, Marches, which is pretty close to you, Chris. And a really, really impressive initiative, which is backed by the DTI or the DIT, and is going to be looking at a really comprehensive approach to developing export markets for food and drink businesses in that area. Now, if every LEP has the funding from DIT and sufficient funding, I'm not talking about, sort of £10,000-20,000 here or there, but really significant levels of funding to really support the growth, their business growth with export markets, that I think is a good replacement for EU funding. So we need to see that coming through our LEP. And by the same token, I think we need to be certain that we're going to get our fair share of the Prosperity Fund for future infrastructure programmes. And it concerns me that we had to fight incredibly hard previously, and we'll have to fight very hard again as being the end of the line for rail, for roads, for airports, whatever, and that we will struggle to see the development, the funding going into the development of our infrastructure that we really need. And I would suggest that the development of the rail link to London, alongside, when put into context of the development of HS2, is case in point. If we continue to be in that disadvantaged kind of context, this is not great news. So understanding, believing, knowing, whatever, that we have got a fair slice of the Shared Prosperity Fund is very, very important. And government has not committed in any shape or form to that, to Cornwall. It's looking for backing growth, backing high returns, high volume, GDP. So we've got to fight our corner on that one. And then the third area is growing entrepreneur businesses, growing small businesses, and how do we provide support to those businesses that can't just walk into the bank and get six-figure capital investment funds, and we know there are a lot out there that can't, as Rob rightly said, you need the personal guarantee, and an awful lot of people in that situation cannot possibly raise the personal guarantee. And in a post-COVID world where the banks have had to be agile and flex and bend with bounce back loans and business interruption and so on, my guess is that situation could get harder, not easier, for some time. So understanding how we're going to support that type of growth, I think, is very important.
Interesting. Wendy, you're our VAT and indirect tax expert. You have spent, well, you'll have lost count of how many hours now talking to businesses across the Southwest about Brexit. Are you picking up on does that come up in conversation, the EU funding piece for Cornwall, or are they too bothered about the VAT and duty and indirect tax consequences to worry you about grant funding? You're muted, Wendy. Yep.
Sorry. Yes, no, so I mean, I guess that's the macro end of things. I have been very much more involved on the detailed preparations at a transactional level. So, but yeah, very conscious that that's a concern for people. Yeah.
Okay. Questions are flooding in, so we better get through this. I'm conscious that we've got about 20 minutes left, so we'd better get into some of these questions. Another one's coming. It's been suggested that businesses carry out a cash flow projection around the anticipated cost increases to prepare themselves for what may be to come. What is the best way to do this? As I'm guessing, it's mostly guesswork. Just before I put that, possibly I might start with Rob for a view on that. As my view is, be inspired by Catherine's input from earlier, which is we may have uncertainty, but we do know potentially what the different outcomes might be. So there's your starting point for scenario planning. And sometimes the way to look at it is in terms of not necessarily measuring what the impact might be, but saying how big could the impact be before it starts to prove a problem for my business. So turn it on its head. How much of the Armageddon nightmare scenario could your business suffer before it becomes terminal? Rob, what would you add to that?
So, I mean, business and scenario planning is something that, you know, we do all the time, really. Just now the scenarios seem to be so diverse, but it's always a good thing to do. I think, you know, you guys as Bishop Flemings will do a lot of this. I'm sure we have pretty good Excel models where we practice that. There are usually 2 or 3 key things in models that drive the scenarios going forward, so you don't have to write a new one for each one. But it's definitely worth doing for sure, and that really take ownership of that is what we always say. You know, really try as best as you can to, you know, to understand where your margins are. This is just common business thing, but we see a lot in the startup world where, you know, quite often we'll see companies focus on trying to get into the US market. They just price everything wrong, and so really now is the time to do the homework on that and do it well. You know, for there are fantastic systems out there like Zero and Float and Futurely now. To actually do this is much easier than it was before. I think, you know, anybody who can count and work a spreadsheet can do this now. You don't have to be as wonderfully trained as it's something that should be done as a matter of course. So do more of the same for sure. That would be my main point.
Thanks, Rob. Well, Catherine, you were articulating earlier on this session that you'd been scenario planning to work out the impacts on your business. Did that flow through into cash flow projections as well? And what lessons can we learn from that? You're on mute, Catherine.
Sorry about that. I'm, you know, looking at cash flow projections on a sort of every other day basis, at least weekly at the moment, because of the impact of COVID and the volatility of sales anyway. And so to actually then scenario plan into cash flow, I think is quite for you know, post Brexit is quite a challenge. But I think if there was one really significant lesson to come out of this last 8 months, is that when you're looking at cash flow, reserves are so important. And you've got, every business has a different, reserves policy, but reviewing one's reserves policy and just thinking about how your cash flow might flow alongside your reserves, and how much headroom do you actually need. And I think we've heard in the last 8 months of so many businesses getting absolutely to the wire before the cash runs out, really getting to that point of absolute desperation. So I think the further out that we can start thinking about what the cash flow implications would be, the better. And I can present some really rosy cash flow scenarios, and I can present some fairly gloomy ones, but my reserves need to cover both. I think the other part of the cash flow equation, which is just, there's so many what ifs in this, are that there are opportunities for growth, and that's what we should all be focusing on as soon as we possibly can, is how do we grow our businesses and make the most of what we need to turn into an opportunity, because otherwise we're frankly all doomed. We've got to create opportunity out of this, and we need to know how we're going to cash flow growth, because growth can be quite expensive. So there are different aspects of it. I have to confess, I can't do a COVID cash flow with all the interruptions that we've had and the volatility we've had, and be able to do 5 different scenarios for January and February, which are not great months on any day of the week, to get into cash flow. But what I can do is say, right, what does my headroom need to look like? What do my reserves look like to ensure that we've got that resilience? So I think it's more about, for me personally as a business, and every business is very different, I think it's about business resilience, cash resilience, not necessarily growth or profit resilience, but cash resilience for the next, let's say, 6 months.
Yeah. I have to say I'm a major advocate of the phrase, you can only control the controllables, and I think there's too many business out there getting frustrated with what they can't control while neglecting the things that they can do in terms of scenario planning, forecasting, having a business plan, getting the right management team, getting the funding if you can access it. And of course, Bishop Fleming can help with that, or reach out to, for the businesses reach out to your existing accountant. Make sure that you're taking the actions that are within your gift to control. Wendy, I'll come to you in a minute. We've got a few cracking EU-related VAT and export and Brexit-related queries coming in, but just want to stay with Catherine for a moment, because one of our attendees has said that they're interested in Catherine's view on how we maintain our food standards if forced to adopt World Trade Agreement under no deal. I think you might want to stay off chlorinated chicken, Catherine, as a dairy producer, but I'll leave it to you to answer the question how you find it.
Well, this is an extraordinary week for food producers. Today we wait completely with bated breath on the American election results, if they are to be upheld. And tomorrow the agricultural bill returns to the House of Lords for its second reading. And there is no doubt that there is an interrelationship between these two things. On Thursday we go into lockdown, and every food consumer, shopper, restaurant goer is going to change their purchasing behaviour. So it's quite a fast moving week, this one. If we have the change in the government, the election results in America, without shadow of a doubt, impact enormously on whether or not we are going to try and go for a deal or a no deal in Europe, and whether or not we will trade with America and therefore, by definition, relax our food standards. And it's very interesting because there's been a lot of media coverage on hormone-produced beef and the use of soy in feeding animals to the detriment of rainforests and. But equally, I think we need to understand what the impact is for the use of pesticides and fertilizers on these absolutely gigantic arable holdings in the States. So we will have a situation potentially where, if we lower these standards, not only are we eating chlorinated chicken, which most British consumers do not want to eat, but they won't always know if they are. And not only will we be eating growth promoted beef, but we will be probably eating, bread and pasta and other farinaceous products made with grain that has been produced with a lot of fertilizer and pesticides. And you might say, well, you would say that, wouldn't you? I think that is devastating for the British health. For us as consumers to knowingly or unknowingly eat this kind of product is absolutely terrible. It really is terrible, because we have done so much in this country and as part of the European Union to improve our diet and to move away from that kind of standard. So why would we want to take such a big step backwards and embrace it? But economically, it will, without shadow of a doubt, significantly impact on agriculture and the production of raw materials for food in this country, because we won't be able to compete at those prices. They will be very, very, very cheap. So for us as food producers, the second reading in the Lords is really important. You may or may not be aware, because not everyone is nerdy as nerdy as I am in following the reading, but the Lords upheld the amendment that was going to ensure we didn't have lesser standards than our own. However, the Commons voted against it and passed that, upheld that, passed that amendment. It's gone back to the Lords for a second reading. It will then go back to Parliament. It's incredibly important for us, and it will fundamentally affect the deal we may or may not do with America. They're looking at their ability to import and export food very closely as being a very central part of the overarching deal. Now, of course, if we do a deal with Europe, a good quality free trade deal with Europe, our inclination to pursue that route will be lessened, because by definition, we would be looking to the same standard as our own. So as food producers and farmers, and I am both, I think it is so vital. It really is.
I think we could probably do an hour session just on food standards, Brexit and the election alone. And yes, so great topic for another day. Wendy, conscious that we are Brexit and VAT go hand in hand, we've got some really interesting questions that I'm keen to get to in the last 10 minutes. So I'll kick off with the first one. I have inventory in the EU. Will I need to pay VAT on it after the transition period? If so, is there any way to reduce my liability?
Thanks, Chris. Yeah, no, that's an interesting question. It kind of depends on why you're holding the inventory in the EU. There certainly won't be any sort of automatic VAT charge on the 1st of January. Generally, people who are holding inventory in the EU, I would expect already to have an EU VAT registration. If you haven't, it might be because you're using one of the simplifications for supply and install, for example, or call off stock. So that it probably does need looking at, because that's the kind of thing that changes after Brexit. So although there won't be a sort of automatic VAT charge arising, it might change what you need to do. For example, you might need a local VAT registration to be able to deal with the related transactions. So that's the answer on that one. Shall I go through and pick up the others?
Be able to see them as well. So yeah, the next one on the EORI number.
Yep. So yes, you are right in thinking that everyone who trades in goods with the EU will need an EORI, which is the kind of international identification number for a business. It's usually for VAT registered businesses linked to their VAT registration number. If you're not VAT registered, it is possible to apply to HMRC for an EORI. If you look on their website, the process is on there, I think.
And I'm assuming if people contact you afterwards, Wendy, you would be able to help them with that. Export and customs documentation, very confusing, but a lot of sympathy there. What's your response to that?
Yes, I mean, it would be nice to be able to recommend the HMRC website, but I do hesitate slightly because I know a lot of people are getting very tangled up in it at the moment. Alternatively, if you have a customs agent or a freight forwarder or your logistics provider, they often have very good practical day-to-day knowledge of what needs to be done, and also obviously very happy to signpost anyone or have an initial conversation with anyone if that would be useful.
And just a piece on that, we've had a number of queries recently about export licenses. There's an excellent department within the DIT based in London that will help you with that. So if anybody wants support on that, reach out to us or your local DIT office. Next question on VAT. Post-Brexit, are there any changes to the EU reverse charge?
I'm sorry, I'm just reading the rest of the question because it's a slightly complicated question, I think. Yeah. In principle, the reverse charge VAT accounting for international supplies of services remains the same, but some of the complications around telecoms potentially do change because there are some use and enjoyment rules relating to use outside the EU. And if I'm honest, I'm not sure that those have been addressed yet by HMRC. So if it's pure normal sort of consultancy, etc. services, reverse charge rules stay the same. If it is something like telecoms, then it will need further thinking about and making sure that you're tracking down whatever HMRC are saying about it. Again, happy to follow up on the detail on that one.
Great, thank you, Wendy. And having just plugged the Department for International Trade, Colin, who would appear to be from the DIT, because that's what's in brackets after his name, and I think I've just deleted. No, I haven't. The question is there. So thank you, Colin, for that little post. Colin just flagged that HMRC have a training grant for paperwork, etc. So I've just published the link there. Hopefully everybody will be able to see it. Rob, I'd like to put this, probably the last question we'll have time for now, just like the panel's view on this one. Just publish that so everybody can see it. There we go. Does the panel think that many businesses will be put off from exploring export markets in a no-deal situation due to high tariffs and paperwork complexity?
Absolutely.
Yep.
So there's your opportunity. If you don't want to do it, don't do it. You know, for what it's worth, my experience of this through our Chassé business is, you know, the solution is there. If not now, it will become there and evident, and we'll all get pretty fit at it pretty quickly. And we'll probably, SMEs particularly, will absorb some of those costs into our processes and systems. And because it's a change, we need to sort of process that and get beyond that. But thereby lies the opportunity. I think categorically business will be put off for that. So fill your boots.
Yeah. Okay. Catherine, do you have a view on that?
Yep, I agree completely with Rob, but I think that there are mitigations that we can put in place ahead of it. So whilst we've got this uncertainty in both Europe and America, there are lots of other countries in the world that we can really work with more with much greater simplicity. So Australia, New Zealand, they're not huge markets on the whole, but they are still good. And certainly the Middle East is a very receptive and open market. China is for some and not for other businesses, but where it works for you, it's a good market to go to. So we have this huge focus on the EU. Now, there are those businesses who are very locked in to trading with the EU, and therefore their business futures in many respects rely on their trading arrangements with the EU. So one can have huge sympathy and understanding for their supply, you know, their continued supply. However, those SMEs in particular, who perhaps don't have very developed export markets, really do have an opportunity to go and seek out those that are just, they might not be frictionless, but they have less friction in them as trading arrangements. And as Rob says, these things will settle down. They will get better. We had a terrible dip in our trade with America 9 months ago because of the tariffs applied through, because of the Airbus situation. 25% tariff. I honestly thought our US market would be gone, and it's coming back, and it's coming back with a certain level of confidence. So, you know, these things just take a little bit. There's a bit of rock and roll, but the stability will be found, and it goes full circle back to just look for your reserves. Make sure you've got the money there to invest in the market and to invest in change if you need to. Yeah,
I think the other thing is to don't suppose it's going to be difficult and complicated and that there is no solution to that. I know going into lockdown, the DIT hosted a number of really interesting webinars on the subject of exporting. There are a number of platforms that you can use to help you work up an export strategy and sell to the rest of the world that help address some of those difficulties, along with cultural issues, language issues, tariffs, etc. like that. So there are solutions out there. We've got time for probably just one more question, which I will start with Wendy for this one. Time for just one more question. We are a company which both imports machinery from the EU and North America, as well as re-exporting machinery back to the EU. We have an EORI number and we'll get a forwarding company to do our customers' paperwork. But do we need to register anywhere else to continue to trade? Wendy, I think I've given you the hospital pass of all difficult questions there. So finish us off with this last question and a barnstorming answer, please.
Okay. Yeah, I guess it all depends on what your terms of trade are with your EU customers that you're selling the machinery to. As long as they're responsible for the importation into the EU, they'll pay the import VAT and any import duty and do all the paperwork, then you don't need to register for that in the EU. The problem is for businesses who are selling goods to their EU customers on Incoterms or on delivery terms that mean the supplier is responsible. For example, DDP means the supplier is responsible for delivering the equipment, machinery to the customer, having done all the import documents and paid all the duty. So as long as you're not in that situation, then you will be fine. But if you are in that situation, you'll need to think about it a little bit more. Brilliant.
Thank you, Wendy. Well, I think that brings us to time. I suppose one of my closing observations from this session, yes, there's a lot of uncertainty, not helped by the pandemic, but I think it's important to be focusing on those things that are within businesses' gift to control. And I think we've identified today there are a number of them: scenario planning, forecasting, where might you be able to get finance, not jumping to the conclusion that working up an export strategy is difficult. This seminar is, of course, put on in conjunction with the Chamber of Commerce. Chambers of Commerce are an excellent source of support, and many of them carry the DIT franchises for their local area. So please reach out to the Cornish Chamber, to the LEP, to your accountant, or indeed to Bishop Fleming. So I think I'll just leave that there as just to thank our contributors today. Thank you, Wendy, for your insightful input on VAT. Catherine, thank you for persevering with the technology. I'm glad you were able to join us, that your insight into some practical examples was phenomenal. And Rob, thank you for your US-UK political special relationship input to equity raising, capital and Brexit. Always good to have a venture capitalist on the call. So thank you to everybody. Thank you for those of you at home and at work joining us today. I've really enjoyed that. This session has been recorded, so if you want to relive that, some of those highlights, details of how to see it will be shared in due course. Thanks, everyone.